We did a piece the other day talking about skew. And one of the things that we learned is that the higher the skew, the more prepared people are for a big down move. And we always thought that skew was more of a red flag, suggesting that you're probably going to get a pretty big outlier move coming soon. And what we learned is that that's probably not the best way to describe skew. The best way to describe skew is that it's really a measure of how many people are buying protection. That's why the out of the money options are bid up so high. Mm-hmm. And right now, let me just get you the latest quote. Skew closed 162.78. I don't think Skew updates intraday. I don't think it goes tick for tick, right? Doesn't it? Just
I don't believe so. I believe you're correct.
I think it's like once a day or something. But 162.78. It's a CBOE proprietary measure of out of the money put and call buying. It's very high right now. So we wanted to take a look and see when markets have big outlier moves, where's the skew trade? Now, based on what we used to think, we thought, okay, probably means the skew is pretty high. But based on our research from Wednesday, we're going to make the argument that it might not mean that. It might mean skew is actually a little bit lower. You ready for this?
I am. Let's do it.
Let's do it. So while in the Black-Scholes model, log returns are normally distributed. In reality, the distribution is non-normal with a heavier downside tail, which means negative skewness. So the skew is an index published by the SIBO, which follows similar methodology to the VIX, but with a higher weighting for out-of-the-money option prices. So a high skew means that the market is pricing in a larger probability for large downside moves, which is what we have right now. But have large skew values been able to anticipate outlier events? Yes or no, Bat?
Oof.
Not a trick question.
Yeah, I mean a high skew. I'm gonna say we have more when skew is low. Obviously, that would be my way of answering this.
Okay, that's fair. Let's go to the next slide, Beth. Hang on a sec. Let's go next slide. Perfect. So using the SPX, the VIX, and skew, we looked at closing dates from 2011 to present. So 13 years worth of data. We looked at when the SPX had outlier down moves based on the VIX derived expected move at the 30-day and the 7-day and the overnight moves. Okay, so 13 years of 30-day, 7-day, and overnight moves for big outliers to the downside. And we examined the skew value immediately preceding these outlier moves. As a baseline, over the life of the skew, its mean and median values were 130 and 128 respectively, significantly lower than the 162 we're at now. Now, again, I need to preface this by saying there's not a crazy number of cases to look at. I mean, there's enough to do this study, but it's not like we had an abundance of cases. So although it's statistically significant, the one thing that when I was talking to Jacob about this last night, the one thing he mentioned to me was, he goes, Tom, yeah, but this is every, there's not a million times when we had these huge down moves. So it's hard to, create enough occurrences. But the mean value and the median values were 130 and 128. We're currently at 162. Does that mean we can't have a down move now? Of course not. It just means we're more likely to have a big down move if the skew was a lot lower. Let's take a look. Well, it didn't make sense to you a week ago.
No, it didn't. I would have said skew is high.
I know.
I would have said, here's how I always answered. I would have always said that if skew is high, the at the money options are high, but the out of the money options in relationship to the two are a lot higher, meaning that they're buying protection. Now, if you look at that, the other side of the coin of that would be that a lot of people are buying protection, which would then, if you look on the other side of that, mean that, when we expect it to happen, it ain't going to happen. And that's the point that I think Jacob brought up, which is pretty cool.
Let's take a look at some of the research here. So in the 30-day outlier moves, and this is 2 times the expected move, okay? 2.5 times the expected move and 3 times the expected move. We had to come up with like research that shows a bigger than normal move, right? We're looking for outliers. So 2 times, 2.5 times, and 3 times the expected move, which only happens theoretically, let's say 2% of the time for 2 times, and the actual frequency is 1.5%. So when we look at this, the numbers here suggest that the skew in those cases is always around 130-ish.
Okay.
The mean skew preceding, the median skew preceding is 128, 130, 132 for 2 times, 2.5 times, and 3 times the expected move. Those are all close enough to say 130 is your number, and that's 2 to 3 times the expected move. That's on a 30-day outlier move, the projection. So let's go to the next one and look at I think we did 7 days, yeah, and then we did 1 day. On the 7-day expected move, the chances of a 2%, 2 times the expected move, 2%, 3 times 0.13. And when you look at the actual, the number, the one thing that jumps off this screen at me was that 3 times the expected move, the actual is 3 times what it is in the theoretical, where everything else is actually a little bit lower. But the skew preceding is 128. So there's no cases yet where a 162 skew led to kind of a crash type thing. It's always the 130
or anything
skew.
above that 130-ish average, right?
Right. But the third line here where it says 3 times expected move, do you see where it says 0.13 theoretical and the actual is 4.4? That's the only thing that jumps out to me on this screen that's other than skew, is that if you're looking for a big outlier move, you're more likely to get it at like 3 times than you are 2 times. 2 times is usually less than theoretical. 3 times is greater than theoretical. Let's go to the 1 day and see if that trend continues. Next slide, Beth. The 1 day. So in the 1 day, yeah, it's the same kind of thing. The skew actually drops even more. We went from 130 on the 30-day to 128 on the 7-day to 127 or 126 on the 1 day. So all of these skews are significantly lower than where we are now before you see a huge down move. The realized frequency of these down moves is always going to be less than the theoretical, except when you get to the 3 times the expected move. I mean, it's a very interesting study from the standpoint of, one, learning that the greater than expected moves happen with less frequency until you get to the real outliers, which are like 3 times the expected move. Those are the
how
painful
can
ones.
you play for something that happens less than 1% of
Yeah, you
of the
can't.
time?
You can't. That's the whole point. You can't. But it happens more than it should theoretically. That's all they're saying. But all of these have a low skew. So we're kind of not in that range right now.
That's why the market was able to come back. Even the S&Ps are up 21.
Let's go to the next slide. So we'll look at some of the takeaways here, because this is, I think we covered them, but let's just make sure. So the VIX and normal distribution statistics did a good job of anticipating 2x and 3x expected moves, but severely underestimated the frequency of 3 times. Skew values that preceded outlier downside SPX moves appeared very typical, slightly lower than usual when looking at short-term outlier moves. And while the skew represents how prepared market participants are for outlier down moves, even at its most extreme, they remain unlikely. And realized outliers frequently come when they are least expected. I think that's the main takeaway. When the skew is lower, that's when you get your outlier moves. And the really bad outlier moves happen more often than they should. The really bad ones. All the other ones happen less than they should.